Over $1 billion of credit card fraud occurs annually.
According to one recent survey, there was approximately $50 million spent over the last 5 years to fraudulent credit repair companies.
Credit problem? No problem. Erase back credit, 100% guaranteed. Remove bankruptcy and liens from your credit file. If you're looking for a way out of your credit problems, don't believe promises like these. Hi, and welcome to Smart Money, where our goal is to help you take charge of your total financial resources. I'm Sid Garcia, and during the next 30 minutes, I'll be introducing you to our Smart Money experts who will share information concerning your credit history. Whether you have excellent credit, a blemished record, or no credit at all, you'll find this information essential to your financial future. We'll show you how you can obtain a copy of your credit bureau report and correct any inaccurate information on it. In addition, we'll alert you to measures you can use to avoid becoming a victim of fraud or credit repair scam. Just what is a credit repair clinic? A legitimate credit repair involves either rescheduling debts or correcting inaccurate credit information. Any guarantee that goes beyond that is probably fraudulent.
The Federal Trade Commission has received a large number of complaints. We've been deluged with complaints from consumers about credit repair companies who promise to erase bad credit and then fail to do so.
They range from very simple to very elaborate, but they all come down to we can clear up anything negative in your credit record. We can restore good credit for you.
There are businesses out there that claim that they will be able to take negative information off a consumer's credit report, and that by paying them money, by the consumer paying them money, quite a lot of money typically, many hundreds or sometimes over $1,000 to do this, that they will by some kind of magic be able to take legitimate, problematic credit information off an individual's credit report. And that's simply not so.
Well, typically a credit repair company charges consumers anywhere from, I'd say, a minimum of $50 to $100, which may include simply a copy of their credit report or a brief analysis of their situation, all the way up to as much as $3,000.
You know, there's ads that are all over the newspapers that will say, credit repair, guaranteed 100%. Nobody can guarantee 100% credit improvement.
Let's talk for a minute about some different aspects of credit repair and what different companies promise they can do for you.
Unfortunately, it is very easy for anyone to go into this business, to make a lot of claims about what they can do, to take people's money, and to disappear. Typically, a company will be somewhat careful in their advertising. They will say something like, if you've had credit problems, call us, we can help. When the person calls them or meets them for the sales pitch in person, that's when the real hard sell begins. That's when the company starts to make all the unsubstantiated promises that they can't keep. The company will say, I don't care what you have on your credit record. They don't even ask you whether it's accurate or not. They just tell you that they can take it off no matter what it is. The company usually will make a lot of representations about how this can be done. For example, they will say, we use loopholes in the federal law to clear up your credit record. Or we make so many disputes with the credit reporting companies that they don't bother to verify anymore, and then they have to take it off. They make up a lot of stories about how their process works to make it seem plausible to a consumer that this can happen, that even though something is accurate, it can be taken off that consumer's credit record.
It is possible that in the very early days of credit repair clinics, they had some limited success because, in effect, the credit bureaus didn't expect the flood, the kind of knock them over with numbers approach that a typical credit repair clinic would use. Send in lots of disputes and try to flood the system in a way that the system couldn't respond. And in not responding, the negative information comes off. Well, it didn't take the credit bureaus long to figure out that there's a way to manage this by identifying the dispute, and in effect dulling or blunting the ability of credit repair clinics to do that. Further, most of the credit bureaus that I'm aware of are not particularly interested in doing business with credit repair clinics, to the point that we say, we have an obligation to the consumer to respond to the consumer's inquiry. We have no such obligation to respond to a credit repair clinic's inquiry. And we will respond to the consumer's inquiry. The consumer can come straight to us, save that money, and we'll clear up whatever's incorrect about their credit report.
The promises of instant credit, we don't care what your past credit history is, we can get you a credit card, those are still occurring in California. I think they're somewhat fewer than they used to be. What they promise people usually is a secured credit card, which means that you are not only going to have to pay the usual and perhaps even higher than usual credit card fees, you're also going to pay an application fee to this company that could range from $50 to several $100s. And then you're going to have to put money into a savings account in order to get a credit card that has a credit limit equal to the amount in the account. Now, you can find a bank on your own who will do that. You don't have to go to somebody else and pay them several $100s to find the bank for you.
We also advise them to be careful about ads that market gold and platinum cards, for example, where they're very vague about just exactly what kind of a credit card is being offered. We find that often these cards are useful only for a catalog that the consumer learns about only after they have paid upfront substantial application fees. They get a platinum card that is not useful in any store but can only be used to purchase goods from the company's catalog.
File segregation is probably the most controversial of techniques offered by certain credit repair companies. Generally, what that consists of is simply a matter of circumventing the credit bureau's identification.
If a consumer takes seriously the idea that by putting a tax ID number instead of a Social Security number on a credit application begins to create for them a new file, then it's very likely they're going to be disappointed. There are a couple of things that might happen here. First of all, the match for the consumer comes from much more than a single number. So a tax ID number instead of a Social Security number is not likely to overcome the fact that by that consumer's name, address, and other indicators, the fact that they have stuff on file won't be identified with that consumer. The second thing is, if we look at a consumer who is, let's say, fairly mature and thinks they're going to clear up a credit history that way, and let's assume they even could fool us, and we would start with a clean credit report with none of that bad stuff on it that they're trying to get away from. If they're looking for credit, here's a mature consumer showing up looking for credit with no credit history at all. Now, what's a credit grantor going to do with that? It's not going to be the kind of credit history that a credit grantor is going to offer. So the consumer doesn't really get credit worthiness by having a blank report, even if they could do that. And it's becoming increasingly difficult for them to do that because our search techniques are very, very good.
The Federal Trade Commission has published a brochure that deals specifically with the problem of companies that promise a new credit identity.
Advance fee loan companies or scams are businesses that have really come into their own in the last couple of years. It's probably, at this point, the area that we get the most calls on over every other type of scam. Basically, what these companies do is they advertise the availability of loans to people who have bad credit or no credit or credit problems or bankruptcies. In general, they literally guarantee that they will make loans to individuals. Of course, all of these, in order to access those loans, the people are required to send in some sort of an advance fee, typically $200 to $300. Needless to say, the companies never make the loans. They typically get back either a list of possible companies that they could apply to for loans, or in many cases they'll get back a letter saying, I'm sorry, but your loan has been denied, and it's also at that point almost impossible to get the money back.
Unfortunately, most of the people that pay that $300 never get the loan because their loan's either never submitted or there's such a high criteria for the loan they simply can't qualify. I definitely don't recommend paying money up front for a promise of money later.
A consumer who has been encountering some problems with either a credit fraud or scam needs to write to us or call us and let us know what has happened. Many times, if the fraud is very, very prevalent, we will work with other agencies to make sure that we stop the scam as soon as possible.
Well, there are some credit frauds that will impact the consumer who has good credit standing. Someone might, for example, try to assume part of their identity in applying for credit, get a clean credit report, or a cleaner credit report than they would otherwise have. If the consumer sees any activity in his or her credit activities, normal stuff with department stores or banks or what have you, and it doesn't look right, they should immediately go to the credit grantor and find out what's going on, and they should immediately go to the credit bureaus and tell them that they think something's going on that's fraudulent with their credit identity. The grantors will look at the problem from the lender's point of view. The credit bureaus will immediately flag that individual's identity as possibly being the victim of fraud. The real thing I think people should concern themselves with is doing the simple preventive things that will keep some of that fraud from occurring. It's the simple things like signing your credit card, keeping the credit card information away from others, the real basic kinds of good sense stuff. That if you think something's going on with your credit accounts, call the credit grantor and call the credit bureaus.
I would strongly urge anyone considering any kind of an offer that's related to credit repair, any advance fee lending or guarantees of loans, bill consolidation services, anything like that, to first of all, assume that the company is not legitimate, and secondly, check it out with the Better Business Bureau.
In January of 1993, the Credit Services Act in California was amended. What now must credit service organizations do according to the law?
California law, which is the strongest in the country, requires that every company that wants to do credit repair business or offering to get your credit in California must first register with the Attorney General's office and must have a $100,000 bond on file with the Secretary of State. The law also provides that no company, whether they're registered or not, can take any money until they have fully performed the services that they promised. California's law covers not only companies that are located in California, it also covers companies that are located outside the state but which offer or advertise their services in California.
The Federal Trade Commission's jurisdiction extends to interstate commerce, and so that we have pursued companies that are doing business across state lines.
In terms of prosecuting a case, we work with the district attorney's office or the attorney general's office.
Any consumer who feels that they have been victimized by one of these companies offering credit repair or similar services should report it to as many agencies as they can. What I usually suggest is that a consumer write a letter describing what happened, what representations were made to them, make copies of whatever documents they have, and then send that same letter to the California Attorney General's office, to the local Better Business Bureau, and to any local consumer offices. And you can usually find those in the white pages of the telephone book.
A consumer can obtain any of the general information that the Better Business Bureaus have available by simply calling the local Better Business Bureau, requesting a pamphlet on whatever particular subject they're interested in, or asking for a list of the available pamphlets. Also, they can write to the local Better Business Bureau and request that same information. In the credit area, we have brochures which deal with credit repair companies on topics such as credit file segregation, also advance fee loan companies, credit card companies, bill consolidation companies.
The Department of Consumer Affairs has many publications to help consumers protect themselves and how to file a complaint with the department. We have a booklet called credit despair to credit repair, which we offer to our consumers who have problems with credit. We also have a California Immigrants and Credit booklet that we give to our consumers in 11 different languages. The languages are offered in Spanish, Chinese, Korean, Vietnamese, Hmong, Russian, and so these are booklets available free from our department to offer to consumers who can't speak the English language but would like to know about their rights and their responsibilities in terms of credit.
The Federal Trade Commission, for example, publishes a series called Facts for Consumers, and there are literally dozens of different consumer topics covered. This one, for example, covers credit repair scams. It gives on the front page fast facts, the most important things that consumers need to know about these kinds of scams, what to look out for, and how to avoid becoming a victim. And then inside they give more details about the particular kind of scam being discussed. These are available free from the Federal Trade Commission's headquarters in Washington, D.C., and they're also available from the 10 regional offices of the FTC.
Remember, you can do anything a credit repair company can do for free or for only a few dollars.
The best protection against any scam, including the 900 number or any other out-of-state scam, is not to get taken in the first place. No one can guarantee for you that they can take off something from your credit record that is accurate and that is not outdated. When someone starts promising you that, no matter what kind of elaborate explanation they have for how they can do it, they are lying to you, and they are just trying to get your money.
A credit reporting agency or credit bureau is actually a clearinghouse of information on a consumer's buying and paying habits. It is a company in the business of gathering and providing a consumer's credit behavior to other businesses that offer credit to consumers. The three largest credit bureaus in the United States, TRW, Equifax, and TransUnion, have files on about 180 million Americans. Additionally, there are about 900 local credit bureaus. Members or subscribers to credit bureaus may include banks, credit unions, finance companies, credit card issuers, mortgage lenders, oil companies, other credit bureaus, insurance companies, collection agencies, and employers.
Equifax receives information from its credit grantor base, its customer base, on various consumers. We receive millions of data on a daily basis via what we call tapes or automated processing. The information can come from also the courts, public record information, such as bankruptcies, tax liens, judgments, and of course the release of the tax liens, of course the satisfaction of judgments, etc.
Contrary to myth, a credit bureau neither tracks all aspects of your personal life nor evaluates credit applications. Credit bureaus are simply businesses that collect and supply information to businesses that have a legitimate reason for accessing your credit bureau file.
There are some things, though, that are common with all credit reports. Every credit report you see will have it on there. The first thing that all credit reports will have on them is identification information. It's going to have the name, your name on it if it's your credit report, you know, your social security number, your address, your spouse's name, anything that's a personal information that's of identification nature. It's also going to have an employment history on it. You know, who have you worked for and how long have you worked there? And in some cases, it even has a salary on there also. Obviously, it's going to have your credit history. You know, who are the creditors? Who are the people that you owed money to? And did you pay it off? You know, what was the payback history on it also? Public records, anything that has been put into the public records at the courthouse is going to be on your credit report. Anything from a judgment to a divorce will be on a credit report. And another thing that's going to be on all credit reports is inquiries. You know, who has contacted the credit reporting agency and wanted a copy of your credit report? So as we look at these reports, these are all things that will be seen over and over again.
The four basic areas of information on your credit report include identification and employment data, payment history, inquiries, and public record information. Your name, birth date, Address, social security number, employer, and spouse's name are routinely noted. The Bureau may also collect and provide other information such as your employment history, home ownership, income, and previous address. Your account record with different creditors is listed, showing how much credit has been extended and how you have repaid it. Accounts which are past due, have been turned over to collections, or have been written off are also noted. Credit bureaus are required to maintain a record of all creditors who have requested your credit history within the past 6 months. Events that are a matter of public record and are related to your credit worthiness, such as bankruptcies, foreclosures, or tax liens, will be obtained through the court system and will appear on your report.
Typically, we also pick up information from public sources, from what you might call courthouse data, information about consumers on bankruptcies, tax liens, delinquent child support payments, that sort of thing that gives an indication that somewhere in the public court system some judgment was rendered.
Credit reports are only issued to properly identified persons for approved purposes and may be furnished in response to a court order or in accordance with your own written consent and to someone who will use it in connection with evaluation of a credit transaction, employment, underwriting of insurance, determination of eligibility for a license, or other legitimate business needs. Negative information can legally be reported for 7 years. Bankruptcy can remain on your file for up to 10 years. Tax liens remain on your report for 7 years from the date they were filed. Negative information cannot be released by a credit reporting agency after either 7 or 10 years, unless you are being investigated for a credit application of $50,000 or more, life insurance of $50,000 or more, or employment with annual salary of $20,000 or more. The Fair Credit Reporting Act was designed to provide businesses and consumers with fair and accurate credit reporting systems. Under this act, you have the right to know what is in your credit file and to challenge any information which you believe is inaccurate. The National Foundation for Consumer Credit recommends that you review your credit bureau report every 2 years for any mistakes or information more than 7 years old. If there are mistakes, you should notify the credit bureau in writing and provide as much information as you can about what is wrong with the report. The bureau will then investigate the disputed information. Upon verification, the credit bureau will then correct any mistake. If the information cannot be verified, it must be deleted. It may also be helpful for the consumer to contact the creditor directly to ensure that the creditor's records are correct. If these steps do not resolve matters, you can file a written statement of up to 100 words with the credit bureau explaining your side of the story. This explanation will be included in your credit report.
The credit grantor is the real keeper of the facts, in a sense, because the dispute would be, I don't owe this bill, or I don't owe this amount of money, or I have an error on this account. In which case, we go back to the credit grantor who owns the account and said, is this really true? Have you got your facts straight? And if the credit grantor says, oh, no, we made a mistake, that bill was paid, or we didn't give them appropriate credit, then the credit grantor notifies all 3 bureaus of the change, so it comes off all 3 credit reports more or less simultaneously. If a consumer wants to ensure that the information that's made available to credit grantors on the credit report is correct and accurate and pertains to them and not somebody with a similar name or someone in their family who's a junior or a senior or the third, then there's a couple of things that a good consumer will want to do. First of all, use their full name the same way every time they go for credit. Secondly, offer the information that's asked for on the credit application, like address, previous address, social security number, and date of birth. This allows the credit bureaus to sort out which generation we're talking about, which individual we're talking about, and it also helps that they use the same name all the time, so that T. Harrington Smith doesn't show up as Harry Smith or Tom H. Smith. Could be the same guy, but it's hard to find. The consumer has a very short form to fill out and sends in and can expect that the thing will be resolved inside of 30 days, typically much less.
If you are married, you and your spouse probably have individual credit files. These files may contain identical or different information depending on whether you and your spouse have shared or separate accounts.
When a consumer has received a final decree for divorce, they should get a copy of their credit report. Then I would recommend that they contact each creditor that's on the credit report. And if the consumer that has the divorce decree knows who is responsible and has a legal document, that should be communicated on to the creditor. Thus, the recommendation, of course, is to make sure that the creditor is aware that a divorce has been filed and there has been a change in status, marital status.
In order to obtain a copy of your credit bureau report, contact Equifax, TransUnion, or TRW at the following telephone numbers. We hope you found this edition of Smart Money helpful. For more information or personalized counseling, I would encourage you to call the nonprofit Consumer Credit Counseling Service to find the nearest location to you. Call 1-800-388-CCCS.
This is our first home. We've been married almost 11 years, and finally we're able to get into a home of our own. And we have 2 kids, and so we needed more space than what we were living in. And this house just seemed to be perfect for us.
Well, the floor plan we wanted had 2 stories, and that was from our kids. They wanted to have those stairs that go up and down, so that was important to them. But it just the way that, with the openness, I guess, of the house. You know, it's got a separate dining room, separate kitchen, and that kind of stuff. So we really liked it.
Hi, and welcome to Smart Money, where our goal is to help you take charge of your total financial resources. If you've been thinking about purchasing your first home, our Smart Money experts will walk you through the steps to home ownership. I'm Sid Garcia, and during the next 30 minutes, we'll cover such important information as shopping for a lender, selecting a real estate agent, understanding your credit worthiness, and explaining your financial obligations in owning a home. Deciding if you want to buy a home is one of the biggest decisions you will make in your life. The first step is to look at the pros and cons of home ownership and you. Some possible pros might include: it's an investment for your money to help create assets. The pride and personal gratification you receive by owning your home. Your housing costs remain constant if you have a fixed-rate mortgage. Possible income tax benefits through the deduction of mortgage interest payments. And the freedom to make choices about your property. Some possible cons to consider would be that repairs and maintenance become your responsibility. Becoming a homeowner takes a long-term commitment. Your housing costs may be more than renting. You may have difficulty in accumulating the necessary entry costs. And the stability of home resale prices is not guaranteed. The first step in home ownership is to shop around for a lender. Now, why would you want to shop around for a lender before you shop for a home? It is very important for you to know how much of a loan you will qualify for to purchase that dream house.
You need to really go to a lot of different lenders and find one that's going to listen to what your predicament was. It's real easy to be intimidated by the lenders, you know, because you want that money so bad, you want that loan, and you're willing to do just about anything. But there are lenders out there that are willing to give you a break, that are willing to understand that you put a lot of hard work into getting out of your debt problems, and you just need to shop around.
We do suggest and highly recommend that the borrower be pre-approved before he go out and look for a home. Pre-approved means that you actually have a loan in place that you have been pre-approved for. The borrower has gone through the entire process of the loan package, has made application, has been verified as far as his income and his deposits and his credit goes, and the only thing that would be missing on that loan package would be the property itself. So everything has been completed beforehand. We've saved a lot of time. All our borrower has to do at this point is to find the home of his dreams and slip that into the package, the appraisal, and we're ready to go.
Before someone goes out to look for a home, they do need to see just how much house they can buy. There's nothing more discouraging than falling in love with a house that you just can't afford. So I encourage people to, again, get on the phone, make that call to your lender so that you can see just how much you qualify for, so you know what areas to shop in.
I definitely recommend a consumer getting pre-qualified before finding a property. A lot of times you hear of people getting denied, and the reason why they get denied is because they find the property first, then they get the financing and they have problems. So the best step would be to get pre-qualified first, then select a home. When you get pre-qualified, you're able to find out how much money you're going to need as a down payment and closing costs. You'll find out what you qualify for, the amount that you qualify for. You also can find out what loan program you'd like to go, what the interest rates are, and also you can find out at that time if you have any credit problems that might need to be addressed.
The first thing that we would want our client to do would be gather information, W-2 forms in regard to his income, payroll stubs, a list of his creditors, and to complete an application and a complete loan package which has several other items in it which explain to him his rights and the nature of the loans that he might be applying for.
Basically, when a lender goes to qualify you for a loan, we look at two numbers. We look at your housing debt, which includes your principal and interest, your taxes, private mortgage insurance if that's required, and hazard insurances. That all adds up to be your housing debt. We don't want your monthly payment to go over 33% of your gross monthly income. The second number we look at is your housing plus your normal monthly debts. That includes if you have a car payment installment type loan or 5% revolving accounts. Those are accounts that you can charge on each month, and the payment requirement changes from month to month. So we'll take 5% of your ending balance, add that to your housing, and that number shouldn't go over somewhere about 38, possibly stretching to 40%, depending on really the whole loan characteristic. Start by making that first phone call. Every lender wants to talk to the consumer over the phone. It doesn't cost anything. You can get pre-qualified over the phone so you know just how much house you can buy. You can talk to them about different programs. As the FHA loan, for instance, doesn't require you have any of your monies saved at all. You can get monies from parents as gifts or blood relatives as gifts for your down payment and closing costs. Under the Community Home Buyers Program, you must have 3% of your own funds, and the other 2% can come in the form of gifts and, in some areas, grants that municipalities have made available to help promote affordability.
The mortgage credit report would be prepared by a local credit agency who would be tied in with national credit agencies. And most lenders would require that that credit agency draw from at least 2 other repositories so that we have information from 3 credit bureaus to base our decision on. They would draw all that information together and prepare the form and send that mortgage credit report to us, the lender, which would contain information in regard to the amount of credit that our borrower has had and what his payment history has been, how he has paid those bills.
Normally, lenders are looking at the credit history in the previous 12 months. If there's delinquency in the most recent 12 months, it should be minor in nature and explainable. As far as the total credit picture, the lender will look at the total picture, and if there's anything that's major that's in the last 12 months, like let's say they were late on their mortgage. If they have an existing mortgage, that would be a very serious reflection of their credit. So that would not be a very good thing to have on the report. When the lender is looking at job stability, they're reviewing. They will verify the last 2 years' employment, and generally the type of employment should be in the same related field if there's a job change. So if someone makes a job change and they are actually advancing their income, that's actually a plus. So they could have a very short amount of time on the job as long as it was in the same type of field. If there's any employment gaps, then they have to explain that, and it has to be documented.
The appraisal is simply a professional opinion of the value of the property. Someone who is licensed as an appraiser will come out and actually physically inspect the property, measure the property, and take photographs of the property. He will take that information back to his office, and he will gather information on like properties in the area that have sold recently or have been listed recently. And then from that information, he will come up with a market value of that home.
An inspection, in very general terms, is an acute review on what the property's about, whether it's structural, whether it's cosmetic issues, whether it's wiring, plumbing. It's just the acute investigation and knowing what could happen to that property as versus what they're expecting is nothing to happen.
Home ownership entry costs range from 6 to 8% of the total purchase price of your home. These costs include money designated for the down payment, closing costs, and your escrow account.
First of all will be the down payment. And for first-time home buyers, entry-level buyers, there are programs for as little as 3% down, 5% down. A veteran can get in with no down payment. But over and above the down payment, there are closing costs, which would include title fees, escrow fees, underwriting fees, points, loan origination fees, if those are applicable to that particular loan. And each program will vary a little bit. And then there will be what are called prepaid items or reserve items, which are not an actual cost of the loan, but are required at closing. Those would include prepaid interest on the loan. That would be from the day you close the loan to the end of the month, because they won't make a payment again for another month. They'll skip that month. So the interest that accrues is collected for those remaining days of that month at closing, along with taxes from 1 to 6 months taxes, depending on where they are in the tax year, and mortgage insurance, if that's applicable for that particular loan, and hazard insurance. So we have 3 major categories: the down payment, the closing costs, and the prepaid or reserve items.
Well, there's a lot of jargon that doesn't make a lot of sense, and it isn't really essential that you understand or remember it, but there are terms like PITI and MIP. PITI simply is meaning pertaining to principal, interest, taxes, and insurance as it pertains to your mortgage loan. Your MIP, mortgage insurance premium, that is charged when you're making a loan with a very small down payment. Usually on loans with less than 20% down, there's a mortgage insurance premium involved.
Mortgage insurance is what the lender will charge our borrower for the privilege of putting less than 20% down to purchase his home. His risk is greater, the lender's risk is greater if he accepts less of a down payment, because the investment of our borrower is not as great. So he asks to offset that risk that our borrower pay mortgage insurance each month, which insures our lender against loss on that particular loan. And the more you put down, the less your monthly mortgage insurance payment will be. points are simply a way that the lender increases the yield on a mortgage. So traditionally, if you don't pay points, your interest rate's going to be a little bit higher. And you can find loans that have no points and no origination fees. Points are expressed in percentages. 1 point is 1% of the loan amount. For instance, if you were to buy a home and the interest rate were at 8.5% at 1 point, that would be 1 percentage point of your loan amount. If your loan amount is $100,000, that would be $1,000. You could get the same loan for probably, as an example, 8 and probably 9% at no points. So you've raised your interest rate, but you've eliminated your one-time fee to increase the yield for the lender. So it's apples and oranges. You're usually paying about the same amount. You just have to determine whether you want to pay points or not. And a good way to determine that is how long you're going to stay in the home. If you're not going to stay in the home for a very long period of time, it's not a good idea to pay the points.
The VA loan is actually, in California, it's a no money down loan up to $184,000. I believe that's across the country as well. It's available for vets, and it's also available, they just recently revamped the program to where it's available for reservists as well. So it's up to the consumer to do a little bit of footwork and get to the lender to get all the information they need in order to determine their eligibility. FHA is the Federal Housing Administration. What it is a loan that's insured by the government. The maximum loan amounts vary from region to region depending on what median prices are in that area. Essentially what they do is they insure the lender against the borrower's default. It's just another form of insurance really on the loan.
I would suggest an FHA loan, which entry costs complete can be as little as 5%, including the down payment and all the closing costs. I would suggest a community home buyers program, which is a program by Fannie Mae. It requires some education, but that education is very beneficial to our borrower and helps them understand the loan process and the entire home purchase process. There are local loan assistance programs, mortgage certificate programs, CHAFA programs. There are several programs designed specifically for first-time home buyers.
There's a number of programs available, one of which is the Community Home Buyers Program, which is sponsored by Fannie Mae, which is the Federal National Mortgage Association. What that is we put people through a seminar that's about 4 hours long to walk them through the thought of buying a house to actually closing their escrow. In that program, I usually throw in information about FHA and VA because there's a lot of people out there that don't really know all the programs that are available. We start out from the beginning with buzzwords, words that everybody has heard but they don't necessarily understand what they mean. Points, what's escrow, who plays what role, who's a real estate agent, what's an appraiser, what's private mortgage insurance, what does a lender do, who's Fannie Mae. We go through the whole steps of all the questions you want to ask, but you're somewhat afraid to ask. And in the forum, we try to keep the seminars around about 50 people so that people feel comfortable with asking their questions. And I was real surprised to see that once you get people started, people are more than willing to jump in and ask that one question that they've been walking around with for years. Again, the benefit of the Community Home Buyers Program is to show you the difference between renting and purchasing, and to actually get you ready and out of that mindset of being a renter and into that mindset of being a homeowner. What we try to do in this seminar is make you make your decision. What are you paying for rent now? What would your principal and interest and what would your monthly payment be if you were to purchase right now? And try to show the benefits as to having control of your own home versus having a landlord that you have to answer to. So we try to weigh the benefits and have you make your own decision. of, okay, let's list why you want to rent, and let's list why you would want to buy. And we certainly go into tax advantages. We go into just the fact of not throwing your money out the window, and because you're gaining equity. It's the biggest purchase any of us will make in a lifetime. So the benefit of the program, of the Community Home Buyers Program, isn't just information, but it does expand the amount of house you can buy. There's a number of programs depending on what banks or mortgage banker you would go to. There certainly are rehab loans. But before stepping into something like that, it really is to the advantage of the consumer to get a home inspection so that you understand just what work must be done on that house. Things you can't see, the home inspector can see. The termite work, roof problems, electrical problems, plumbing problems. Those all can be very devastating in the first year of ownership if you're not prepared for the cost of that. So yes, fixer-uppers are around and rehab loans are around, but before you get into that situation, I advise people to make sure they get a home inspection.
Basically, a real estate agent as a whole is like the captain of your ship. The real estate agent guides you through the whole real estate transaction. Now, there are two different kinds of agents. There's a buyer's agent and there's a seller's agent. And the buyer's agent basically represents the buyer. Their responsibility is to take the buyer out, show them property. Once they find a property that the buyer would like to purchase, then the real estate agent helps them in writing an offer. Once the offer is written and there's a binding contract between the buyer and the seller, then they go to escrow, and the buyer's agent helps them through the escrow process also. Then there's a seller's agent. The seller's agent's responsibility is to market the seller's property, do the proper advertisements, also conduct open houses, and once there's a written offer on the property, then it's the seller's agent's responsibility by law to present any offer that is written on that property, regardless of the price.
To define a buyer's agent in real estate, you primarily have to reduce it down to someone who's definitely going to take all the aspects and concerns of a buyer, itemize it simply, and discuss them with the buyer, especially if you're talking about a couple and a family. And it's taken from the top as far as how they look at themselves as a business, and what they're projecting for the immediate, and making a transition from renter to buying, homeowning, and the idea of working with a financial planner or a tax preparer. That's probably one of the things that are lacking. And that's what a buyer's agent should be introducing them to, are the network of players that are going to play a part in making the acquisition and from there on after, so they can stay as homeowners as opposed to losing it 1 or 2 years later.
A consumer would go about finding a real estate agent by a referral. If they can ask around to see who has purchased a home, maybe within the last 6 months, ask them what that real estate agent did, and maybe ask for a referral. That's one way that a consumer can select a real estate agent.
The real estate agent should be immediately involved with the financing. It plays a major part in how they're going to be able to negotiate not only the offer, but any counter offers that might play a part.
Two of the decisions you will need to make about home ownership will be the type of property and the location of the property you want to buy. Property choices might include a townhome, a condominium, a duplex, or a single-family dwelling. You also need to decide if you want to live in the suburbs, in the city, close to schools, or close to work. These are all important issues to discuss with your real estate agent.
By law, in helping a consumer select a neighborhood, we cannot tell them if it's a good neighborhood or a bad neighborhood, but there are some things that the consumer can do to ensure that they feel comfortable in buying in that neighborhood. And one of the things they can do is drive by in the evening time after work, see what kind of people are outside, if there's people hanging out in the street, if there's loud music, or what they can do is contact the nearest police station and get a crime report on the area. And by law, they are entitled to this. So those are some of the things that they can do to ensure that they're getting the neighborhood that they want.
I think they just need to go around and determine where they're going to work, where the kids are going to go to school, and the traffic patterns, timing, seeing how the kids are going to grow up at a certain point, and what it's going to take to drive them to Little League or whatever 5 or 7 years from now, and whether or not they're going to be able to deal with it.
Well, the first thing you want to do, once you find a property that you want to purchase, you want to make sure that your realtor pulls up the comparable sales in the neighborhood. Make sure that they pull up comparable properties the same size as the property that you wish to purchase and find out what the sales prices have been in the last 6 months. And that will be able to help you to determine whether you're writing a reasonable offer on the property.
It takes some planning. A person has to determine what they're capable of handling as far as a payment. And once they determine what they can comfortably handle, if it's within their budget, and if it fits into any of the many plans that are now available for low to moderate income and minority borrowers, that they then need to seek a good loan officer or a lender to find a program that they can fit into. There are so many programs that are available now for first-time home buyers. A community home buyer program is an excellent one. It allows very flexible underwriting, even a little more flexibility on their credit. The buyer has to go through a regular education certification so that they do have some idea what kind of an obligation they're entering into. But the American dream is still there, and it's available. And all they need to do is just be persistent.
First-time home buying is actually a very exciting time for first-time home buyers, I feel. I've been involved in that quite a bit. And the steps that a person would take to get towards that dream, I think, are very basic, but I would also say that there's a lot of help out there right now. In terms of the opportunities right now, it is a very exciting time. There's a lot of programs out there now that require a lot less down payment. There's programs with as low as 3% down. I would strongly recommend a person to look into the programs available. In a lot of communities, Consumer Credit Counselors offers first-time home buying counseling. And basically, my message to most people is to not be afraid to go investigate. You would be surprised how many people have enough money to go buy a car, to put down on a car, not knowing that that's enough money to put down on a house.
Don't get discouraged. You just need to keep a real positive attitude and keep trying, and your hard work will be rewarded. And that's what I found happened for us. It was a struggle. It was a lot of hard work. Even though we made mistakes, we got ourselves into a bad position. But by just staying positive and working towards a goal, it really paid off for us.
Oh, we love it. We're just, I mean, at night, we stand up at the top of the stairs and we look down and we think, oh, this house is so nice. It's just perfect for us. We just, it's what we dreamed about.
We hope you found this edition of Smart Money helpful. For more information or personalized counseling, I would encourage you to call the nonprofit Consumer Credit Counseling Service. To find the nearest location to you, call 1-800-388-CCCS.
The creditors started calling, and I was unable to make payments, and I would come home and there'd be 10, 12 messages on my machine, and I was in an abyss.
We were taken to court by a collection agency.
I was using credit cards to survive.
I think people are beginning to see that the dangers of unsecured credit and revolving debt is insidious, basically. It can really add up very quickly.
Emergencies do come up, and sometimes, you have to rob Peter to pay Paul.
I was at my wit's end and really didn't know what I was going to do. Actually, I felt like I was ready to jump off of a cliff at that point.
Hi, and welcome to Smart Money, where our goal is to help you take charge of your total financial resources. I'm Sid Garcia. During the next 30 minutes, I'll be introducing you to our Smart Money experts who will share information concerning your personal finances. Whether you're over your head in debt, have just experienced an unexpected financial crisis, or have no money management plan, you'll find this information essential to your financial future. We'll show you the warning signs of debt, what to expect if an account is turned over to a collection agency, your rights under the Fair Debt Collection Practices Act, the pros and cons of bankruptcy, and some basics of money management. There is no general all-encompassing way to determine how much credit you can handle. However, one long-standing rule is that if your monthly payments on debts, not including your home mortgage payment, exceeds 20% of your take-home pay, you most likely have reached your credit debt limit. Follow along as I go over some of the basic warning signs of debt. Being consistently late with bill payments, using savings for daily expenses, making minimum payments on credit card debt, obtaining cash advances on credit cards for living expenses or to pay other creditors, using debt consolidation or other types of loans to pay overdue bills, receiving calls from collectors, facing creditor lawsuits or repossessions, always keep an open line of communication between you and your creditor. If you are overextended, depending on the type of debt and your circumstances, your creditor may be able to offer you different options for debt repayment.
When an individual is faced with problems, and usually you know ahead of time if you are not going to be able to pay the bill, it's important to contact the creditor. Write out the budget, show them what you're doing, and send that to the creditor and show them your proposal. It's always a good idea to get it in writing. If they do not send it to you in writing, you send it to them in writing, what you have proposed to do. Always make sure that you've listed the individual who you've spoken to, and incorporate that into the letter, send it certified mail.
Probably the most important aspect of a consumer-creditor relationship is communication.
If a consumer has a credit problem, they shouldn't ignore it. They should acknowledge that they have a problem. If it's a serious problem, they should contact their credit grantor or their credit card issuer immediately. Tell them that they're experiencing a problem. It may be a short-term problem or it could be a longer-term problem. And if that's the case, they would want to work out an alternate payment schedule with their financial institution.
At times, however, there is a continued delay in the payment being received from the member, the debtor, and as it reaches 30 days, that's still not a critical point, but as it reaches 60 days, and if it were, for example, an automobile loan, that's when we have to give serious consideration to whether or not it would be necessary to repossess the vehicle.
Take the time to talk to your creditor about one of the following possibilities: extension, loan revision, loan refinance, consolidation loan, or line of credit.
Included are things such as revision agreements, and this is really an option that is just a short-term fix, more designed to address just a short-term problem. A revision agreement is an opportunity to, for example, skip or delay up to 3 months worth of payments and just add that on to the end of the loan agreement. Another option we have is to refinance if there is other collateral that the member has available, whether it be autos or real estate. There is an opportunity to consolidate outstanding debts and use those sources of collateral as backing for an extended type of loan. The opportunity or the advantage there is hopefully to reduce the payments and get the member back on their feet in terms of being able to manage the outflow of expenses.
In our consumer finance company, Household Finance Corporation, in that arm of the business, a person might look at consolidating all of their bills. Maybe that's the answer.
If these options are not available, you run the risk of your account going delinquent and being charged off.
A charge-off is a situation where at some point in time the debtor is either unwilling or unable to make payments on the obligation. When it reaches that particular point in time, and it varies among financial institutions, the institution will actually charge off the obligation. On the credit union side, basically what that means is it no longer appears on our books. For the member in the credit bureau, it does show as a debt that the member was unable to repay, and it becomes a part of his or her credit history.
If you find yourself in debt and your account is turned over to a collection agency, contact them immediately.
The thought of a collection agency is very frightening, and they have visions of ski mask people and this and that. This is not true, at least not in my company. We train our collectors to be very sympathetic to debtors. We train them to talk to them, to evaluate the situation, to help them, to counsel them as to the best ways to clear either that debt or their credit in general. And my collectors are taught to listen before they say anything to find out what the debtor's problems are and how we can help them clear it. Naturally, we want to collect the money, but you can't always do that on the first call. The average individual is not trying to get out of paying his debts. There are many reasons why an individual has this problem. One, it could be loss of employment. Two, it could be illness, health problems, divorce, companies that close down and leave these people without jobs, and they're maybe too old now to get back into the workforce right away. But if they make a conscientious effort, I think we can help them.
The government has special powers not available to other creditors to collect tax obligations, student loans, and other debts owed to a government agency.
I was delinquent on my student loans by about 6 months at that point. And the companies were really hassling me. I was getting calls all the time with 800 numbers that I could never get through to. You know, I tried to call them on my lunch breaks. They'd start calling me at work.
The government agency only gives the person collecting those loans or the attorney very strict guidelines. If we cannot work out something and if they can't make payments, we can't come to a reasonable solution, then we would have to take judgment. A garnishment is where you ask, for instance, the employer to, instead of paying the money to the employee, pay a portion of their wages directly to the creditor, directly to the person to whom you owe the money. And the federal law is, for California, it's 1/4 of the disposable income. The first things after you get the judgment is you place a lien by recording the judgment in the county where the person lives, or any other county where their debtor owns real property, and that sits on there. And when a person wants to refinance their house or wants to sell their house, then it'll be picked up by the title company, and the title company will say, well, you have to pay this lien before we can give you the loan or before you can sell the house. And that's very common way. It just sits there and it's paid off at a later time. And it stays on there for California, states vary, but in California for 10 years. And then you can renew it another 10 years.
The Fair Debt Collection Practices Act prohibits abusive, deceptive, and unfair debt collection practices by debt collectors. The primary purpose of this law is to see that people are treated fairly by debt collectors.
They'd even call at 7:30 in the morning, harassing us. Several times, I mean, I was crying on the phone because, I mean, it was just so bad.
My creditors called me at work, and at that time, unbeknownst to me, that was illegal. But I did not know that, and I would have to lower my voice, try to convince them, totally embarrassed, try to convince them that I would be dropping a check in the mail for them that very day that would take care of the past due balance and get them off my back as soon as possible. And of course that would, but when they didn't receive that check, then the calls, you know, and I'm talking, you know, 10, 12 creditors at a time.
When collectors call you up and they start harassing you over the phone, it's demoralizing. They start to try to chip away at your character and at who you are, and it's insulting. And I think that's what starts to give you the low self-esteem and the embarrassment that you start to feel, because they don't try to work with you. All they try to do is get what they want, and that's the money. I've learned to talk to them very calmly, very professionally, and let them know that if they are going to take me to court, or if they are going to do whatever they feel they need to do, then they need to follow through with it, because at that point it becomes a threat.
California and federal laws specify what creditors and collection agencies may and may not do when attempting to collect a debt. Collection agencies are not allowed to call you late at night or make a series of calls one right after the other. Tell your employer, neighbors, or friends about your debts, or publish your name in the list of delinquent debtors. Pretend to be from a consumer credit reporting agency, governmental agency, or attorney's office. Threaten to take you to court unless they actually intend to do so. Send you written forms that are made to look like legal documents. Force you to pay more on a debt than you legally owe.
Consumers have a lot of rights under the Fair Debt Collection Practices Act that they can enforce themselves. If they feel that they are being harassed by a collection agency, if they don't want to be contacted by the collection agency, they can simply write a letter to the collection agency under this federal law stating that they do not wish to be contacted any further. This does not mean, of course, that they no longer owe the debt or that they can't be sued for it, but they can stop the phone calls and they can stop the contacts by simply writing this letter. Another thing that they can do if consumers feel that they have been harassed by a company, if they are subjected to calls at work from the company, or in any way they feel that the company may be violating the federal statute, they can contact the Federal Trade Commission, because the Federal Trade Commission enforces the Fair Debt Collection Practices Act, and there are a number of prohibitions against calls and contacts that are illegal. The Fair Debt Collection Practices Act only applies to third-party collection agencies. It does not cover the creditor directly, so the retailer that the consumer bought the goods from, if they do their own collections, then they are not covered by this law. However, the Federal Trade Commission does enforce a very general statute that prohibits unfair and deceptive practices, and it is certainly possible that if a creditor is involved in egregious collection practices, the Federal Trade Commission can look into it. So consumers can send those complaints and should send complaints about creditor collection practices to the Federal Trade Commission.
Complaints concerning debt collection practices should be filed with the Federal Trade Commission, as should complaints about credit issued by retail stores, department stores, small loan and finance companies, oil companies, public utility companies, state credit unions, or travel and expense credit card companies.
We were feeling very overwhelmed and very ashamed.
We very seriously considered bankruptcy.
I researched quite extensively the entire bankruptcy process. I talked to lawyers. I went on and on, seeing if it was an option for me.
Oftentimes a consumer will face debt that is so insurmountable that they really are not in a position to pay back their debt. That happens with a very small percentage of the population who's having difficulty. But in that case, they might want to look at bankruptcy as a last resort. It is a very serious step. They should look at the implications of filing for bankruptcy. It will impact their credit history for up to 10 years. It may take away some of their possessions and assets. So they may want to look at that as an option if they are in very serious debt.
Bankruptcy is a legal declaration that an individual is unable to pay his or her debts. Bankruptcy achieves two purposes. It establishes equity among creditors and it provides debtors with a fresh start. The bankruptcy law generally provides for two types of cases. These are known as liquidation and reorganization. Chapter 7 is a straight liquidation. That is, your non-exempt assets are given to a court-appointed trustee who arranges to have these non-exempt assets turned into cash and paid to creditors.
13 is a reorganization which is supervised by the federal system or by a federal trustee, a Chapter 13 trustee. And it is it's a repayment plan where individuals are able to, again, take their net disposable earnings over and above what they need for necessary living expenses, and to pay those over back to their creditors, or pay that money to the creditors over usually from a 3 to 5 year period of time. It's not as scary as some people hold it out to be. There is what's called a first meeting of creditors and examination by a federal trustee, and essentially when somebody files bankruptcy, they're providing information to the court and in turn to any creditors that wish to examine the file about their property, about their debts, and about their financial background. Also, we're required to currently, if somebody does file a Chapter 7 straight bankruptcy, they have to indicate that they have been advised of the Chapter 13 reorganization. But as far as any court, in most cases, they do not have to appear before a judge, but they do need to appear before again, federal trustee, and to respond to any questions about their assets and about any preferential payments they may have made, usually within 90 days prior to filing the case.
I see a lot of rushing in because they've waited too long and they've got to stop the foreclosure. And that's what you get whenever you file a bankruptcy. You get the automatic stay, which is very important, probably the most important thing about filing a bankruptcy. You stop foreclosure, stop evictions, stop lawsuits against you, stop trials. It stops a lot of actions against the debtor and property of the estate.
The bankruptcy law provides that you will remain liable for certain debts even if you have received a discharge. Taxes owed within 3 years of filing. Credit you obtain by filling out a false credit application. Willful or intentional damages you cause someone else. Alimony and child support payments. Debts which you did not disclose in your filing. Fines or penalties you owe to any governmental agency. Fraudulent financial obligations. Educational loans obtained within 5 years of filing. And claims from an earlier bankruptcy. Although bankruptcy may be the answer to financial crisis in some cases, anyone who files bankruptcy should be aware of these basic consequences. A bankruptcy may stay on your credit record for up to 10 years. You may be asked a question at any time on a credit application, have you ever filed for bankruptcy? A bankruptcy may affect obtaining future credit or credit cards, thus affecting your day-to-day living standards. A bankruptcy may affect your future ability to rent. A bankruptcy may prevent or delay a home purchase. A bankruptcy may cause loss of self-esteem or damage family relationships. A bankruptcy may affect future employment.
I've seen bankruptcy judges actually refer people that happen to come before them. They've referred them to consumer credit counselors and said, you need some advice. And even if you get your discharge, you still need some advice because the thinking, the mind thinking needs to be rethought, reprogrammed.
Consumer credit
Credit Counseling Service really has a three-part mission. The first and foremost is to educate people on the wise use of credit. And we do that by going into high schools, colleges, employer workplaces, businesses, social groups, battered women's shelters, places where people need to hear about how to handle credit or money more wisely. The second part of our mission is to provide confidential counseling to people who, for some reason, are experiencing problems managing their money, whether it's medical, divorce situations, kinds of things that throw our budgets out of whack. And thirdly, for people that are experiencing financial problems, we have a debt management plan that's endorsed and supported by creditors nationwide that allows people to get themselves back on track and avoid bankruptcy.
Visa would recommend that if a cardholder is having difficulty paying their credit card bill and they've contacted the issuer, that they should consult the services of Consumer Credit Counseling Services, which is a national nonprofit organization that is devoted to helping consumers work out these kinds of problems. They are typically free or low cost and are very helpful in dealing with these types of problems.
As customers reach a 60-day delinquency, we do give them an overprint which explains consumer credit counseling and gives the 800 number, so that possibly they've seen that overprint before they've ever even talked with us.
We can refer them to a number of sources that could provide budgeting assistance, one of which is consumer credit counseling.
What do I think about consumer education? Do people know how to handle money? No. I think that's one of the biggest problems with people. They don't know how to handle money. They live from payday to payday. They never put a nickel away. If they're without a paycheck for 1 week, everything piles up on them. You know, these wonderful sales and these advertisements and all these things telling you how great it is to have all this, you have to pay for it in the end, so you better know how to budget your money.
If you find yourself overextended for one reason or another, the first step to gaining control of your finances is to develop a spending plan or budget. Once you have analyzed where you are currently spending your money and the dollar amount needed to repay your debts, you can develop a well-planned monthly budget. Let's hear from some experts, their tips to help you scale back your spending and stretch your dollars.
It's important that the individual sets a plan. The plan is the most important thing when facing problems, because if you have a plan, there's hope. You have direction.
First of all, we want our clients to set their priorities, make sure their rent is covered, their food's the basic. And as far as suggestions, as far as cutting the budget, what we do is give them information regarding food programs that might assist them, give them shopping tips, let them know about maybe some couponing that they could do, just to give them information that they're comfortable with. We also let them know how to shop the seasons, so they're not out buying peaches dead in the middle of winter.
Be sure that we make a clear distinction between wants and needs. One way to do that, and this comes from Dahlstrom and Company, is to give ourselves a fourth degree when we go shopping. Ask ourselves, number one, do I really need this? Number two, do I have to have it today? Number three, what will happen if I don't buy it now? And number four, why have I gotten along this long without it? The other one is developing a systematic savings for periodic expenses so that when those bills come due during the year, we don't have to go in debt to pay them. That would be the gift budget, the clothing, school supplies, especially transportation maintenance on the automobile, registration, license, those kinds of things. Oftentimes it's hard to do. It's hard to stick with that.
Consumer Credit Counseling Services throughout the United States have helped hundreds of thousands of individuals gain control of their finances by providing educational seminars, conducting confidential budget counseling, and managing debt repayment programs.
In the last 2.5 years, I've taken my debt from $10,000, more than $10,000, to $1,200.
We hope you found this edition of Smart Money helpful. For more information or personalized counseling, I would encourage you to call the nonprofit Consumer Credit Counseling Service. To find the nearest location to you, call 1-800-388-CCCS.
we do want to reestablish credit, at least have one, a Visa or MasterCard for emergencies only.
One of the things that I'm doing to reestablish credit at this point is to get a secured credit card. And I have enough savings at this point, which was a big change in my life, to be able to do that with some integrity. And I've started in a very small way, that I've decided to buy $30 to $60 worth of supplies for my business with this and pay it back monthly. But I'm looking at something that's very small and doable.
I did establish credit with a reputable company for a Visa card.
Hi and welcome to Smart Money, where our goal is to help you take charge of your total financial resources. I'm Sid Garcia, and during the next 30 minutes, I'll be introducing you to our Smart Money experts who will share information concerning the reestablishment of credit. If you are now back on solid financial ground with your past debts repaid, this is an opportunity for you to reapply for credit. We'll guide you through the steps of creating a solid money management plan, as well as updating your credit bureau report. In addition, we'll show you how to select the best credit card for you and why you don't need those instant credit offers. Let's begin our program by outlining the guidelines for the wise use of consumer credit. Establish a steady employment record. Develop a budget including the necessities of life, savings, and credit payments. Deal only with reputable firms. Shop for credit carefully, examining finance charges, annual percentage rate, annual fee, and all other costs. Make all credit agreement payments on time. And contact the creditor immediately if you cannot pay as agreed. Step 1 to reestablishing your credit is to develop a monthly budget.
As far as the first steps that a person needs to take for establishing their credit or starting to get into the credit market, if that's what they're looking for, say a young person coming out of college or a new family looking at their financial future, obviously the most basic step is looking at your budget, making sure that whatever kind of credit you're going to be asking for that you'll be able to repay. So the first step would be sitting down and actually going through the steps of a personal budget. From there, you'll know what types of disposable income you have that can be used towards credit purchases.
I would recommend, again, first and foremost, is develop a spending plan and to stick with it, to know exactly how much income they have and how much they can afford to extend toward debts. The creditors are going to look at that when they apply for credit again. They'll want them to fall within certain debt-to-income ratios.
The budget is nothing more than just a simple tool that you use to get what you want with money. Now, a budget helps you to do just 3 things. That's all a budget does. It helps you to do 3 things. It helps you to plan your expenditures, it helps you to control them, and it helps you to record them. Now, if it becomes just merely tedious bookkeeping, it's not serving its purpose. So a budget is really nothing more than just a financial roadmap to get you to your goals and to your aspirations. It's a way of deciding ahead of time what you're going to do with the money that you have. And it can also become a planning tool for the future. It can help to answer that, well, can I or can't I situation. Can I afford to buy a new car or can't I? A budget helps you to live within your means because you're planning ahead what you're going to do with the money that you have. It also provides a means for resolving some of those family financial arguments, particularly when one spouse accuses the other one of spending too much money or maybe spending money inappropriately.
When planning your budget, make sure you examine your needs, the things you need to survive, versus your wants, the things you would like to have but can do without. Write your budget down so it can be carefully followed.
Now, all budgets, whether it's something like this that you pick up at a bookstore or a stationery shop. I got this over at one of our local bookstores. It was $3.79. These little Dome Home Simplified Budget books are very adequate. The forms inside are very concise. very adequate for what you might want to do in budgeting, whether it's something a little bit more elaborate and expensive. This one I got at a local bookstore. It was $10.50. There again, the forms inside are a little more complicated, a little more extensive, but very adequate. Or even whether it's something that you make yourself. This is just what we use at home, just a little loose leaf binder with dividers for the different sections. Or whether it's something that a financial planner would give you, getting you ready to do some investment, or even a software program like Quicken.
What exactly is credit? Credit allows you to buy and use goods and services now, but to pay for them later. When evaluating an individual's credit worthiness, a creditor will look at what we call the 3 C's of credit: capacity, character, and collateral. Open-end credit includes bank and department store credit cards, gasoline company cards, home equity lines, and check overdraft accounts. Open-end credit can be used again and again, generally, until you reach a preset credit limit. American Express, Diners Club, Discover, Visa, and MasterCard are but a few of the many alternatives to choose from. When shopping for secured credit, the creditor must tell you in writing and before you sign any agreement the finance charge. The finance charge is the total dollar amount you pay to use credit. It includes interest costs and other costs such as service charges and some credit-related insurance premiums. It is extremely important to obtain a copy of your credit bureau report and update all information. If you have a bankruptcy, foreclosure, write-offs, etc., all these items will need special attention.
If a consumer's credit report has got public record data that haven't been updated, that aren't correct, typically the best way for the consumer to deal with that is to provide a copy of their copy of the corrected information to the credit bureau, along with a letter saying, this is an error on my credit report, and here is the document that shows that the bankruptcy was settled out or the tax lien was settled out. It's probably easier to do that than depend upon a correction of public record data from other sources.
I would recommend that they send us a copy of the document that shows the satisfaction. And what we will do is take that information and verify it with the courts to make sure that it is correct and put it in the file correctly.
There are legitimate techniques of reestablishing and improving your credit rating. The simplest one, of course, is simply getting copies of your credit reports from all the major credit bureaus, TRW, TransUnion, Equifax, looking at those reports and finding out if there are errors, because in many cases there are some inconsistencies and some problem areas on the credit report which can be legitimately disputed. Another legitimate technique and very positive and win-win situation is going directly to the creditor. If you are in fact late on a payment or you simply had an account charged off years ago and you just never paid it, you can always go back to that creditor, renegotiate with them, and oftentimes pay off the account to have them remove the negative information and mark the account paid in full.
Be aware that accurate negative information on your credit bureau report cannot be removed before the designated time period of reporting. Move forward slowly on reestablishing your credit. Limit the applications which you complete for new credit obligations.
Sometimes consumers who've had a problem with credit, and it could be from very legitimate reasons like loss of job or some change in marital status or that kind of thing that doesn't represent bad character but represents a problem, want to reestablish good credit. And some of them think the way to do that is to put out a lot of applications and see if somebody will lend them the money that they'd like to have. What happens then is each of those credit grantors looks at all the inquiries that have been made against the file of this individual in the credit bureau and says, this person is out shopping for a lot of credit. I think I can't lend on that basis. This individual may be going over his or her head in debt again, and that's a bad sign. So I think the correct thing for any consumer is to focus on where they think they can get credit and make that application and see it through and work with the credit grantor and try to have the credit grantor listen to what they have to say about their credit worthiness. Different credit grantors have different rules. Different credit grantors provide different levels of credit for people at different rates. based upon their creditworthiness. But the idea is not go out and see how many different applications you can fill out, hoping one of them will come through. It's very self-defeating.
Here are some suggestions for reestablishing credit from our smart money experts.
There is such a variety of conditions, benefits, interest rates, charges with the varying credit cards out there today, over 6,000 of them, as a matter of fact, that the important thing is for consumers to find the card that works well for them, for their particular needs, depending upon their payment patterns. If they're going to carry a balance, they'll want to look for low interest. If they pay off in full every month, then the interest rate really isn't a primary criterion. They would want to look for a card with no annual fee, with a 25-day grace period, and maybe one that provides the kinds of benefits. There are so many co-branded cards available now that would give them the other benefits that they would need, whether it's airline miles or whether it's cash back at the end of the year. Perhaps it's discount points for the purchase of a particular item, an automobile, in a department store, those kinds of things. We recommend that they start slow and keep it low.
Obviously, a checking account, a savings account, establishing a relationship with a bank is very important. And from there, just taking it, I think, one step at a time, not rushing it. Too often we see people want to establish credit, but they make the common mistake of over-establishing credit, opening up too many accounts and maybe going over their limits where they get into trouble. So I would say take the basic steps of budget, open a checking savings account, and then very slowly start to create a positive credit history.
A secured visa is a way the credit union can offer a credit card to somebody who is beginning to reestablish credit or starting new credit. We do have security on it. We do secure 10% over what we're giving them on the Visa line. However, for instance, if we give them a $300 Visa, they would need on deposit in their shares $330 that we would hold. They would still go ahead and be able to take their interest on the account, but we would hold that as security for the Visa card. We do now have a qualification, though, procedure for the share secured Visa, and that would be that we would not be able to do it if there were any outstanding delinquencies or charge-offs or on the credit report. So we do make a lending decision on this.
When someone is trying to reestablish credit after a period of financial difficulty, we would suggest that they start off with some type of secured credit, which would be easier for them to acquire, establish a consistent payment history, and then look at some retailers. We would be looking for a period of consistent payment history with another creditor.
If you're not able to set up an account with a secured credit card company, what you can also do is contact a merchant, a local merchant. Explain the situation to them. Many times they are more than happy to help you in reestablishing your credit. Ask them if you can go on a 90-day program. In other words, you can make increments of 3 payments to make your purchase. The whole key is that the merchant is a subscriber to the credit bureau. The whole key is getting on that credit report for a new payment pattern.
We encourage our members to, first of all, take a look at those debts that they have had problems paying on in the past and first get them caught up to date. Beyond that, to not incur any further debt and to try to, for a period of approximately 12 months or so, reestablish their creditworthiness through small secured types of loans, whether that be savings secured type loans, secured credit cards, or loans that are secured by collateral. By doing that, it will begin to reestablish the members' interest in paying their debts and establishing a good history, which is really the foundation of our review and their ability to obtain credit in the future.
Credit terms differ among card issuers, so shop around for the card that is best for you. Which one will depend on how you plan to use it. If you plan to pay bills in full each month, the APR may not be extremely important. However, if you expect to use the credit card to pay for purchases over time, The APR and balance computation method are important terms to consider.
If you're a consumer who doesn't have any credit history and you're a first-time credit shopper, or if you're someone who is re-entering the credit market, you may have had a problem in the past, first thing you should do is shop around for the best deal for you. If it's a credit card, you should look at a couple of things. One would be the interest rate, which is very important. You'd want to look for the lowest interest rate possible. And fortunately today, our society has a very competitive credit card industry, so there are a lot of good deals available. You'd also want to look for the annual fee. Some cards don't require an annual fee, others do. If you are going to be revolving your card, you will definitely want to look for the lower interest rate. If you are not going to be revolving your card, that is, you're going to be paying off every month, then the annual fee is something, no annual fee is something that you'd want. You'd also want to look for a grace period. Be sure that there is a grace period of around 25 days. And you'd want to be very careful about how the interest is calculated. Look for that. So shop around. There are a lot of good deals.
Truth in lending requires creditors to give you certain basic information about the cost of buying on credit or taking out a loan. These disclosures can help you shop around for the best deal. The annual percentage rate, or APR, is disclosed to you when you apply for a card, again when you open the account, and it is also noted on each bill you receive. It is a measure of the cost of credit, expressed as a yearly rate. A grace period allows you to avoid the finance charge by paying your current balance in full before the due date shown on your statement. Knowing whether a credit card plan gives a free period is especially important if you plan to pay your account in full each month. Most credit card issuers charge annual membership fees. These fees range from $15 to $75.
A credit grantor will look at a consumer's credit history, and if they have had some delinquencies in the past, that could pose a problem for them in getting new credit, depending upon how they have paid their bills over time. So a consumer does want to keep in mind how they have paid their bills. If they are experiencing difficulties, then that will probably impact their ability to obtain new credit in the future.
As far as a savings account goes, anybody who's within our member group can open a savings account. That is the way they join the credit union. So they open their savings account. That entitles them to all the benefits of the credit union membership. As far as a checking account goes, we are using check systems, and when a member applies for a checking account, we do use check systems to verify if they've had any derogatory type history at other financial institutions. If they are on we report to check systems ourselves, and we also, like I say, check on it when we open the account. If they are on check systems, we are not opening checking accounts at this time.
We, like all lenders, put a great deal of emphasis on the individual's credit history. We review the credit bureau as well as the information that is obtained on the application. We pay particular attention to not only the good attributes that are shown, but also those that are not so good. For example, charge-offs or collection efforts or judgments or just a pattern of delinquent payments. Quite frequently, if there is too much of that type of negative information, it will cause the loan to be denied.
Reestablishing credit following a bankruptcy may pose specific obstacles.
When an individual files for bankruptcy, of course, they are now branded. What happens is it is then reported to the public recorder's office, and it is now a public notice. And so what happens is this is now reflected on all of your credit bureau reports, and it can stay on for up to 10 years. So basically, when you have filed a bankruptcy, it will follow you probably for the rest of your life, because every application that you have, you will have to answer that question. Did you file bankruptcy? Yes.
One of the things that I suggest, of course, is getting perhaps a secured Visa card, something to that effect, because that's their own money. those cards are virtually credit proof. I advise them they may want to shop around for rates or whatever. But also, of course, it's a fact of life of them having filed that if they are able to obtain credit, they're going to be paying higher interest rates.
It can be very difficult to reestablish credit once you have had charge-offs or debt repayment problems.
Yeah, it takes time to reestablish your credit. Paying money to a credit repair company, looking for a quick fix is not the answer. In most cases, people that do that end up with worse credit than they did before because that money that you spent on the credit repair company is money that you could have used to pay off your bills.
The promises of instant credit, of we don't care what your past credit history is, we can get you a credit card, those are still occurring in California. I think they're somewhat fewer than they used to be. What they promise people usually is a secured credit card, which means that you are not only going to have to pay the usual and perhaps even higher than usual credit card fees, you're also going to pay an application fee to this company that could range from $50 to several $100s. And then you're going to have to put money into a savings account in order to get a credit card that has a credit limit equal to the amount in the account. Now, you can find a bank on your own who will do that. You don't have to go to somebody else and pay them several $100s to find the bank for you.
Late night television is the host of numerous business opportunities, oftentimes scams, do-it-yourself, get-rich-quick schemes, and so forth. Many of them fall into the credit repair category. Oftentimes, secure credit cards, as I mentioned previously. People will call, they ask you to call the 900 number, for which you're paying, anywhere from $1 to $5 a minute. So you may pay $20 or $30 just to receive information which you could have found for free.
There is a related problem for consumers who have had problems with their credit histories in the past. They are often targeted now by companies that are marketing what are called secured credit cards, where they are told that if they pay ahead of time, set up an account with a bank or some sort of a savings institution, that they can get a credit card like a Visa or a MasterCard. And the problem with this often is that, first of all, it's not clearly disclosed how much money they will have to deposit in advance, and that money has to remain in the account, and that is essentially used as collateral when they want to use their Visa or MasterCard. So it's not quite the same as having a typical credit card. If all the disclosures are made up front and the consumer understands what they're getting into, and if they make sure they're dealing with a reputable financial institution, they can be helpful in establishing new credit. But we have a brochure that advises consumers to watch out for the possible pitfalls with secured cards. We also advise them to be careful about ads that market gold and platinum cards, for example, where they're very vague about just exactly what kind of a credit card is being offered. We find that often these cards are useful only for a catalog that the consumer learns about only after they have paid upfront substantial application fees. They get a platinum card that is not useful in any store but can only be used to purchase goods from the company's catalog.
You can reestablish your credit worthiness by showing that you're willing and able to pay your debt. When applying for a loan, be candid about your past problems. This way, they won't come as an unpleasant surprise if your lender finds out about the problem when looking at your credit bureau report. Once you have reestablished credit, follow author Deborah McNaughton's 10 Commandments of Credit. 1. Thou shalt not overextend thy card. 2. Thou shalt not be a compulsive charge addict. 3. Know thy credit report. 4. Know thy legal rights. 5. Thou shalt not sign a blank charge slip. 6. Know thy account numbers and the names and addresses of thy creditors. 7. Respect thy creditors when thou hast a problem. 8. Thou shalt review all charge statements. 9. Thou shalt pay bills promptly. 10. Thou shalt destroy all carbons from charge slips. If you are currently faced with a financial crisis or would like more information about budgeting or consumer credit, there is help available.
Consumer Credit Counseling Service really has a three-part mission. The first and foremost is to educate people on the wise use of credit. And we do that by going into high schools, colleges, employer workplaces, businesses, social groups, battered women's shelters, places where people need to hear about how to handle credit or money more wisely. The second part of our mission is to provide confidential counseling to people who, for some reason, are experiencing problems managing their money, whether it's medical, divorce situations, kinds of things that throw our budgets out of whack. And thirdly, for people that are experiencing financial problems, we have a debt management plan that's endorsed and supported by creditors nationwide that allows people to get themselves back on track and avoid bankruptcy.
We hope you found this edition of Smart Money helpful. For more information or personalized counseling, I would encourage you to call the nonprofit Consumer Credit Counseling Service. To find the nearest location to you, call 1-800-388-CCCS.